All right, we have more changes unfolding in the U.S. mortgage market and the U.S. housing market. Changes that have all the data from 2023 now officially in. We have Zillow, Realtor.com, and Redfin all syncing their numbers, their December numbers, into our database. We have some interesting markets to point out, and also what to expect going forward. As we have a new note from Double Line Capital that you'll want to see. That's Jeffrey Gunlock's firm, and what they see happening to home prices in 2024 as the Fed begins to cut rates, something that some of you may find surprising. But before we get started, thank you for liking and sharing these videos. It really helps me out. And if you haven't subscribed yet, make sure to do that to get these regular updates. So mortgage rates, they've fallen considerably over the last 2 months, down from 8% to 6.5% today. And this has been shaking things up in the housing market. For one, cash out refinances, they've jumped over the last 2 weeks, a market that has been on its deathbed for almost 2 years now. Look, I speak to a lot of lenders, lending companies who use our CRM software, who use Snapforce CRM for the sales side of their business. Now, the vast majority of our clients who do cash out refis downsized a lot once the Fed started hiking rates. Back in the summer of 2022, we saw lending company after lending company just gut their staff, just lay off loan officers left and right. We had lenders with hundreds of seats, a couple with over 1,000 seats, over 1,000 licenses, who gutted their offices, laid everyone off virtually except for like a handful of loan officers. Saw this happen to dozens of companies in the summer of 2022. Most of them still use our product, but they only have a couple of seats nowadays. Well, last week I received multiple calls from these old clients letting me know that they're preparing to ramp back up. As they say, business over the last few weeks has picked up considerably, which is interesting because mortgage rates are still high. 6.5% rate is still very high. Most homeowners, the vast majority of homeowners, have a 4% mortgage. So who are these people jumping to refinance? Well, I asked that question, and from what I was told, it's not like a huge spike in new business that they're seeing, but it's a significant increase from what it's been like. People who are struggling financially have been waiting for the chance to see rates fall before doing a cash out refi, which means those people go from having a 3 to 4% mortgage to now a 6.5% mortgage, which means that they must really need the money. But right now is not the time to do that, especially if in the coming months, we're going to see mortgage rates fall even more. Now, all this is just like anecdotal, obviously, but interesting nonetheless. I'd be curious to see what the data looks like for January in a few weeks. But in the meantime, we do have brand new numbers, brand new data from the big three real estate brokerages just synced into our database. This is for December, which means we now have the entire year of 2023 finished, and it gives us a more complete picture for how the housing market really looks. And one thing that stands out is inventory. We've been hearing that inventory or active listings rather are so low they can't rise to pre-pandemic levels. They won't return to where they were, which I don't buy for a minute. It takes time, no doubt, but listings will increase. They already have been slowly rising. Take a look at this. According to Realtor.com, we now have 752,000 active listings. This is a 3-year high, folks. And with higher inventory comes cheaper home prices. And whenever you speak about this topic, some people seem to freak out. It's like they just can't handle hearing anything other than positive news about the housing market. Well, for normal folk who are looking to buy a house, it's important to have as much information about the market as possible, even if it means hearing about the possibility of home prices falling, which is what Double Line Capital raised in a new note that they just released. This is Jeffrey Gunlock's firm, one of the most respected investors. We just watched an interview, by the way, that he did in the last video, his warning about the Fed's current monetary policy and the levels of U.S. debt, the trillions and trillions of dollars that we have in debt. If you didn't watch that, you should. It's an important interview. Well, he put out a warning about home prices also. Not a warning so much, just a forecast for what his firm's predicting we'll see this year in 2024 in the housing market. Look at this. And if you want access, by the way, to our system, our research database, or Snapforce Real Estate Insights to use the housing market maps and all the data, the link's in the description. But take a look at this. He writes, Double Line Capital, lower mortgages will soften home prices in 2024. They write this. Now, in a twist of irony, I believe lower mortgage rates could actually soften home prices. More affordable financing could incentivize would-be sellers who've been stubbornly locked into 3 to 4% mortgages. There's a magic number for fixed-rate mortgages that I think would unfreeze the housing market. In other words, a price bringing together willing buyers and sellers, a market-clearing price. By my sites, that number has a 5% handle. The supply and transaction volume unleashed by mortgage rates in the 5% zone might decrease home prices nationwide or at least flatten them. The effect on home prices also will depend on whether the lower mortgage rate unleashes more buyers or sellers. Another consideration, pent-up demographic demand might lurk out there. Overlooked, ready to extend the march to higher prices. That's possible, but it's not my base case, he says. Now again, that's coming from Jeffrey Gundlach, how lower mortgage rates are what's needed to finally cause home prices to fall. Higher mortgage rates were never going to stay higher forever. We all knew the Fed was going to cut in 2024. We used to talk about it all the time last year. The point of the higher rates was to squeeze the economy, squeeze the consumer, the homeowner, the everyday American. That was the Fed's goal from all this. Squeeze businesses to the point where they would have to lay off workers, hope for a pop in the unemployment rate, but loosen policy before it gets bad enough to cause a full-blown recession. Well, we are at that point right now. We're on the backside of the Fed's tightening campaign, which means we'll find out soon if they'll be able to skirt by without inducing a recession. I still doubt they will, but we'll see. People also seem to forget that mortgage rates weren't high during the last housing crash. When home prices were falling after the great financial crisis, the Fed had already cut the night rate. We had rock bottom mortgage rates for years, over 2009, 2010, 2011. Home prices didn't bottom until 2012. Throughout all those years, those 3 or 4 years, mortgage rates were very low. Now, I'm not saying we're going to see a massive crash like that, but what I am saying is just because the Fed cuts rates, it doesn't mean home prices can't fall. And it doesn't mean that home prices are just going to balloon back up. And according to Jeffrey Gundlach, lower mortgage rates are exactly what's needed to induce a drop in home prices. And look, speaking about home prices, let's check out Zillow's brand new December data because we have it all now. We have the full year. They just synced it into Snapforce yesterday morning. This is the home value map, right? These numbers are pulled from the same place as Zillow's Zestimate numbers that we're all familiar with. These are slower moving numbers, but the median list price data set is actually interesting right now as it shows us what's really happening on the ground month to month. You'd expect to see some change now that mortgage rates fell 150 basis points. Well, take a look. The Pacific Northwest is seeing exactly that. Check out Seattle, Washington. A big drop in prices from just a month ago. Out of the 3,300 listings, the median list price fell 10.5%. Current median price is $780,000. That's $92,000 off the median, off the peak of the market rather, in June 2022, and only 20% over December 2019 prices, 28% over December 2018 prices. Same thing if we go north to Snohomish County, Washington. Beautiful area, by the way. It's unfortunate. So damn expensive out there. Median list price fell $703,000, or the median list price fell to $703,000. That's 9% off its peak and still 38% over December 2019 prices, 45% over December 2018 prices. We also had some requests for Spokane, Washington. Let's check out that. Spokane is now down 5%. Typical listing here is asking $439,000. That's still 45% over December 2019, 60% over December 2018 prices. And a real wild area is Phoenix, right? Maricopa County erased basically all of its losses. We were hearing all last year how Phoenix will be the first to crash. Well, it had a mini crash, but it reversed course some. The typical home in Maricopa County is now asking $535,000. That's still 50% over December 2019 prices, 60% over December 2018 prices. But if we jump over to the home value map, we can see this better, as that was the median list price. This is the actual home value data set. Now, Phoenix home values are currently down 6%. Typical home is valued at $458,000, still 56% over December 2019 prices. But look at this. Look at the home value data, how it goes all the way back to 2006. What you'll notice is the vast jump and fall in prices. Look in December 06. Median home value in Phoenix was $290,000. Then by December 2011, they were cut in half. They literally were halved. falling to $135,000. Then they started to rise, 135, then 165, then 226, then 241, then 257, then in 2019 all the way up to 293. Well, now we're at $458,000. Look, home prices move a lot, but they move slowly, very, very slowly. The bottom line, if you're looking to buy a house right now, your best bet is to narrow your search to make to what you like, and then make some lowball offers. See if you get any bites. It's very possible you may find yourself a good deal, but I wouldn't buy at market prices, me personally. All right, that wraps up this video. Like, subscribe. I'll see you next time.